you've all heard this advice that you should leave it to the professionals, that debt is bad, and that you should have a budget if you ever want to get ahead in life. Now, what if I told you that all of this advice is dead wrong? And I'm going to prove it to you in this video. So let's start with myth number 1, the debt lie. And I want to tell you why the wealthy love borrowing money, why I think you should too. So let me guess. You were raised to believe that debt is toxic, right? I mean, something to avoid at all costs. You might have heard it like, stay out of debt and pay cash for everything, and debt will ruin your financial future. I mean, that's pretty much the financial commandment number 1, right? Well, here's the deal. I've got news for you. Because while you're busy thinking about how you can save cash for your next investment, the wealthy are using other people's money to get even wealthier. Now, let me be clear. I'm not talking about racking up credit card debt for designer clothes or financing that new Beamer that loses value the second you drive it off the lot. I mean, that's amateurish. You don't do this. Here's what I'm talking about. I'm talking about strategic debt. You see, the kind of debt that actually builds wealth. So let me show you something that the wealthy use that your financial advisor probably never ever mentioned it to you. And it's called a securities-backed line of credit. And the shortcut is SBLOC. Now, think about it like this. If you owned a rental property that was bringing in steady cash every month, you wouldn't sell it just because you needed some quick cash, right? So you would probably get a so-called HELOC, a home equity line of credit. You would borrow against that property while it keeps making you more money. Well, an SBLOC is the same thing, but with your stock portfolio. So instead of borrowing against a house, you're borrowing against your income producing stocks. So this means that your stocks keep working for you in the market. They keep paying you dividends. They keep growing in value while you're getting access to cash for whatever opportunity comes your way. Let me tell you a real life example, right, about an opportunity. So last week, I talked to a friend of mine and he needed $30,000 for a house down payment. He wanted to buy another house and he had $100,000 in high quality dividend stocks and ETFs. And this portfolio made him around 12% annually. Now, here's the deal. You see, most people would have sold some of their stocks and therefore no longer making the 12% return goodbye to finance this $30,000, but I told my friend to get an SBLOC at 6.25% interest rate. Now, the math is absolutely beautiful. Let me run you through this. So he keeps $100,000 in his portfolio, right, with the stocks and ETFs, and this keeps earning him $12,000 a year. Now, the loan is only $30,000 times 6.25%, so this is $1,875 in interest. So the net profit is more than $10,000 that he's still bringing in and also getting this new house. And here's the best part. Getting an SBLOC is actually easier than getting a HELOC. See this? This is a website and it's called m1.com. As you can see on this website, most major brokerages are already offering an SBLOC. You see, Fidelity is offering it, Schwab is offering it, E-Trade is offering it, Vanguard is offering it, and many, many others. So as you can see, most major brokerages are already offering an SBLOC. All you need to do is ask your broker for one. And you see, if they don't do it, well, just move your account to M1 Finance and it's called M1.com. They got your back. I've no affiliation with them. I'm not getting paid to say this. I just have seen this website. I've heard very good things about it. My broker offers an SBLOC, so therefore I'm personally not using them, but you can use them, no problem. But you see, it gets even better. Unlike an HELOC, with an SBLOC, the interest rates are usually way lower. Let me show you. You see, this is the website. It's called bankrate.com, right? And on bankrate.com, they show you how much right now a HELOC costs. And you see, it's around 8.5%, maybe 8%, 8.13%, but what did we just see? The SBLOC is only 6.25%. So it's cheaper, right? Now, the other thing is that with an SBLOC, there's zero paperwork nightmare. There's absolutely no application process. And get this, they don't even check your credit score. Yeah, you heard this right. I mean, you could have a credit score that looks like the temperature on a lukewarm pizza oven and you still get approved. Actually, there is no approval. You're still getting it because they're not lending based on your credit. They're lending based on your investments. So this is where it's probably the easiest money you'll ever access. And you see, that's exactly how the wealthy think about debt. They're not afraid about it because the wealthy, they use it strategically, because they use it to make them more money. Now, this is just one of their tools, but for now, let's move on to myth number 2, the budgeting scam. And this is what I want to explain to you, why saving money is keeping you broke. Yeah, you heard that right. Let me be honest with you. You can't save your way to financial freedom. Write this down. Yeah, I said it, right? All these apps tracking every penny and those color-coded spreadsheets that you might have, the guilt every time you buy a fancy coffee, it's all keeping you stuck. And here's why. While you're stressing over, I don't know, saving $3 on groceries or clipping coupons or saying no to every little pleasure in life, the wealthy are playing a completely different game. You see, the wealthy, they're not asking, how can I spend less and save some more money? They're asking, how can I make my money work harder? Now, let me show you why this matters with some real numbers. I'm jumping over here to my handy dandy iPad, and I say that you have an initial investment of, let's say, $200,000. And let's say that the monthly contribution that you're adding another $500 every month. And we want to see what it does over the next 15 years. So that's what we're going to plug in here. And the estimate interest rates, we're using 8% because that's what most financial advisors are getting you, maybe around 8%, right? And the compound frequency, we can set this to monthly and click on calculate. And you see, this is scenario 1. So in 15 years, you will have around $834,000. Let me show you scenario 2, the wealth focused scenario. So everything stays the same, but instead of saving more money, here's what you do. You figure out a way to get more in returns. You figure out a way, and I'll show you in a moment, how to get 20% return. Now, look at this. In 15 years, you will have 4.4 million compared to the previous 834. So no, that's not a typo, right? I mean, the difference between these scenarios isn't about saving more money. It's all about making your money work harder for you. Third scenario, that really messes with the stop buying lattes crowd, right? So here's scenario 3. This is where keep your coffee approach, I call it, right? So same $200,000 to start, but here's what we do. No contributions at all. So you're not contributing anything at all. But look at this. If we now hit calculate, you're still ending up with $3.9 million. Yeah. You read that right. You see, by focusing on returns instead of saving money, you can keep your coffee, you can keep your social life, you can keep your sanity, and still end up with almost 4 million. So maybe the question isn't, how can I save more? The real question is, how can I earn more on what I already have? By the way, really quick, if you do want to save money without living like a monk, I made a video showing you how to easily save 20% of your monthly income. And I'll put a link in the description and probably also somewhere here, but that's not even the point. The point is that most people don't even think this way. Most people think 20% return, that's impossible. Is it though? Or is it just what traditional financial advisors want you to believe? Why they keep collecting fees on your mediocre returns? There's a bunch of different strategies how you can accomplish them. Let me share one of them with you. So this strategy is called the dividend reinvestment twist. And here's how it works. Let's say that you're smart and own some dividend producing stocks or ETFs. Now, most people just automatically reinvest their dividends into the same stock. Now, that's lazy, right? Instead, here's what I would do. Pool those dividends, then wait for opportunities, and then strike when the market pulls back. It's like being a sniper instead of just spraying bullets everywhere. It's kind of what Warren Buffett does. Remember his favorite quote? Be fearful when others are greedy, and be greedy when others are fearful. But here's where it gets really interesting. So let's talk about myth number 3, the Wall Street lie. And this is where they say you can't beat the market, but then they're using this strategy. You see, your financial advisor probably tells you the same thing they tell everyone. Just buy and hold good companies and invest in index funds, stay in it for the long haul, and maybe you get 6 to 8% per year. Boring advice that keeps you stuck in the slow lane. So Well, what happens? Well, you get frustrated watching your money grow at a snail's pace, and eventually you might start looking elsewhere, right? You might get this hot stock tip from your buddy or some random post on Reddit, or maybe you try cryptocurrencies because there's all the crypto bros, right? Or maybe you have a newsletter that gives you the guaranteed winner. See, I get it, because when you're getting tired of this 6 to 8% returns, those promises of quick riches, they start to look really good, don't they? But here's what nobody tells you. There's actually a third option. That's the strategy so powerful that Warren Buffett himself uses it. Yeah, the Warren Buffett, this guy that's worth what, $117 billion or something like this. And yes, this is about trading options. Now, you've probably heard about trading options, right? And usually you see two types of traders. You see stock traders who just buy and sell stocks, right? And then on the other hand, you have option traders trying to hit home runs with risky bets. But here's what most people miss. The real money isn't choosing one or the other. It's combining them both strategically. And that's where the wheel strategy comes in. So think about it this way. Think about it like being a real estate investor, right? But instead of properties, you're dealing with solid companies. And here's how it works. Step number one, pick a company that you actually want to own. Think like Apple or Microsoft or Google, not some of these sketchy penny stocks. Now, step number two, instead of buying it at today's price, you make an offer to buy it cheaper. Let me give you an example. Let's say Apple is trading at $220 right now, and you might offer to buy it at $200. That's buying it at a 10% discount. Pretty good, right? But here's the crazy part. You get paid to make that offer. You see, this is like someone giving you $300 and saying, hey, you know what? If Apple drops from 220 to 200 by the end of the week, you can buy it at a 10% discount. And if not, you don't do anything. And by the way, you just keep this money. Wouldn't you take that deal? Of course you would, right? Now let's move on to step number three. If you end up buying the shares, you can make money while you own them. Because now you say, I'll sell my Apple shares that I just bought for $200 for $210 by the end of the week. Again, you get paid to make this offer. So let's say that you're getting another $200, right? And here's the deal. So the stock either stays below 210 and you keep the $200 and your shares, or the stock goes over 210 and you sell for a profit, plus you still keep the $200 and then you just start over. And that's why it's called the wheel strategy, because it keeps spinning and generating cash flow for you month after month. So here's the best part. This strategy works in any market, because you see, market's going up, you make money. You make the $300 and Apple keeps moving higher, right? Market going down, you still make money because you still get the $300 to buy Apple at a discount. Market going sideways, you still make money. Now, this is completely crazy. And now you probably know why Wall Street doesn't want you knowing about this. Because once you do, why would you ever pay them fees for mediocre returns again? Now, look, I know what you're thinking. No, Markus, this sounds great, but I don't know anything about options. Or you might say, I've heard options are risky. Or you might say, I probably need a huge account to do this. Or you might say, you know what, it's probably too complicated for me. And you know what, I get it. You see, that's exactly what the bankers on Wall Street wants you to think. But here's the truth. If you can understand my real estate example from earlier, I promise you can understand the wheel strategy. So if you want to know more, I have a video for you in which I show you exactly how to get started with this strategy, and you can watch it here.